Welcome to Escala Perspectives podcast. I'm Holly Brenchley, investment analyst at Escala, and today I'm joined by Roy Keenan, co-head of fixed income at Yarra Capital and portfolio manager of the Yarra Enhanced Income Fund. Roy brings over 3 decades of experience in credit markets, running the enhanced income strategy for over 20 years. The Yarra Enhanced Income Fund is a core credit strategy aiming to deliver returns of RBA cash plus 2.3 to 2.8%. The fund is included on our approved product list as part of the fixed income allocation. Roy, thank you for joining us today.
Thanks, Holly. It's great to be here.
Roy, could you start by giving us a brief background on Yarra Capital Management and the range of investment solutions that the firm offers?
Yeah, so Yarra's been in existence for 8.5 years now. Prior to that, we were known as Goldman Sachs Asset Management, so we've got a really long history in Australian financial markets. We're about just over $20 billion in assets under management, and we cover everything from Australian equities to basically private equity. And then in the fixed income space, we are around $8 billion today. And we do everything from Australian government bonds right through to private credit and everything in between, which is sort of RMBS, investment grade credit, hybrids. So we're a pretty diverse business today.
Could you share a bit about your own background and experience in the industry and introduce us to the key members of the fixed income fund team?
Yeah, so it's, I probably could speak for probably 20 minutes on my career, but my life's been fixed income. I started in the 80s with State Insurance Office, which was a big asset manager back in the day. And, I think I had a pretty good grounding from the bottom up. I worked in operations and got to know how things work. And then I got my big career break and moved across to Treasury Corporation of Victoria, which they're known of today in the sort of late 80s. And I always say to people that, it was a great learning experience because that's when Victoria went broke the first time. And I learned so much about fixed income and markets during that period. And then in 1992, I got approached by JB Weir, and I became a price maker and trader in both government, semi-government and corporate bonds. And then my career just generally progressed. Technically I've been with Yarra 33 years. But I've had JB Weir, Goldman Sachs, and now Yarra in my change of profile. So I moved into credit and started the Enhanced Income Fund in 2002 and been the portfolio manager for the Yarra Enhanced Income Fund for over 20-something years. So my team, I'm very lucky to have a high-quality team. We've got 10 people in managing that $8 billion that we have today. We have probably, if I name a couple without naming them individually, because it'll take me forever, but the most important person for this fund is Phil Strano, who's the Deputy Portfolio Manager. He's been with Yarra and with me for 8 years now. And my other co-head of fixed income is Darren Langer, who sits in our Sydney office. And Darren concentrates more on the higher quality government bonds and semi-government and manages the Yarra Australian Bond Fund.
Yarra's investment process involves close collaboration between the fixed income and the equity analyst teams. Can you share a bit about how this integration works in practice and what benefits it brings to your process?
Yeah, from my perspective, it's pretty unique that asset manager doesn't split their fixed income and equity business. And, it sort of goes back, and I think it's probably Yarra's greatest achievement in sort of 8.5 years, is that from day one, we decided, having come, spun out of Goldman Sachs, that it doesn't make sense for fixed income and equities to be separated. And you get more as a one investment team than you do being separated. And, I think where it works really well, so to bring it to life, we share morning meetings together. We talk about companies, we talk about the macro environments. But it even goes to the point where we share company meetings today. So during that, we've just gone through the August reporting period. Fixed income will attend company meetings with the equity team. And why it works, I think, is that traditionally fixed income managers tend to only see the CFO and treasurer, and they're really well trained to tell you what you want to hear. What we get to hear is the chairman, the CEO talking about their business and their growth aspirations, and I think it gives you a great, clearer picture. And probably the other thing that, from my perspective, which works really well is, particularly if a new company comes to the market, and they might be an ASX-listed company that our equity business invested in for years. And I remember years ago, NextDC did a fixed income bond. We didn't know a lot about NextDC, and from our equity team being a shareholder, we got to learn really quickly about their financial models, but also about what made that company tick. And it meant that we could actually model the company correctly, but also think about, as a bondholder, what do we need as protections in documentation that suits that a business of that type, which is really capital intensive.
Thanks, Roy. Can you walk us through the investment philosophy behind the Enhanced Income Fund?
Yeah, I think it's not just the Enhanced Income Fund. I think it's what Yarra stands for. We believe in research. And I think, the philosophy for 20 odd years in the Enhanced Income Fund hasn't changed. It's always been that, we think there's great opportunities to sort of find value in fixed income markets if you do the work. Sometimes in fixed income, it's not about just what you buy, it's what you don't buy. And, I think, we've now had a process in place that has matched our philosophy. That process has evolved and changed over 20 odd years in my time with the Yarra Enhanced Income Fund. But, it is about trying to do that bottom-up research, which generates those. Ultimately, if you bring it down to a couple of words, it's getting paid for risk, right? And if you do the research and know the risk, then you can actually assess what you need to get paid for that risk.
On Yarra's process, you employ what you call a top-down and bottom-up approach. Could you elaborate on what these mean in practice and how they contribute to overall portfolio construction?
Yeah, it's a good question. So bottom-up, I think virtually every credit manager would do the same, and it's just how you go about it. Bottom-up research is essentially looking at the company's cash flow, getting to understand management, how's that company positioned from a point of view of competitors, what's its advantages, what's its disadvantages in the marketplace. And that bottom-up research forms your view on where that credit sits and how it will survive cycles. Once you actually then, you have to blend how does that company fit into the macro environment. And we spend just as much time on assessing the macro environment and where a credit will fit in to a portfolio. And I can give you an example of there'll be times when the real estate sector doesn't look great, interest rates are rising, valuations are falling, and we will probably put a more macro overlay over our portfolios, which will say we probably want to avoid property. Yet the bottom-up credit research might say, well, these companies look good still, right? So you need to really find that blend, but also in a portfolio that doesn't have like the Enhanced Income Fund, which is not purely measured against the benchmark. We try to do a return above cash. You then can sort of pick and choose where you want to invest and where you want to avoid given your macro view, but also whether you have securities like, if we think interest rates are falling, for example, we might have a bias to buy more fixed rate securities and lock in coupons for our investors than be exposed to floating rate securities, which are going to adjust with the RBA cash rate.
You place a strong emphasis on generating internal credit ratings for securities. Can you walk us through how your team develops these ratings and how they influence your security selection?
Yeah, it's really important. So every investment we make, it doesn't matter if it's in investment grade bonds, private credit, which this fund doesn't do, but we do measure those types of companies. We put a Yarra internal credit rating on everything. And in some ways you do that because we're not paid by rating agencies to look through cycles or vice versa. And rating agencies are paid by the company to rate the company, right? So we come what we think is more unbiased view. I would say Yarra's internal rating is more dynamic and probably responds more to the economic cycle than what you would normally have in a Standard & Poor's or Moody's rating. What we try to do in our rating is we forecast cash flows out 3 years, but we also overlay the macro environment on top of that. And so what will traditionally happen is that because our internal credit, we will assess like companies' balance sheets, their ESG policies, the market dynamics that you will see in particular where an industry is, and the ability of that company's maybe to repair the balance sheet if times are tough. So a public company is going to have a great ability than potentially a private company. So all those factors come into play, And what traditionally happens with your internal credit rating for us is we might differ 1-2 notches from the rating houses, and that could be for particular reasons. Recently, over the last 2 to 3 years, our internal rating at Yarra has been below the rating houses for things like the REIT sector. And we all know the issues the REIT sector have had from valuations and their gearing going up, vice versa. So we tend to, what it means for portfolio construction is if our internal rating is 1 notch below the rating houses, then we need more return to justify the portfolio. So it becomes a natural screening in and out of the portfolio depending on where your internal credit rating is.
And Roy, the fund's process highlights documentation as a key step in security selection and risk management. Why is reading and thoroughly understanding documentation so important to the team, and how does it influence your investment decisions?
Yeah, I was taught this 30 years ago. You never assume anything. And, reading documentation can be something that saves the day and basically might protect you in bad times for a particular company, but also can be a positive that you pick up something in documentation that no one else in the market is. And we've had plenty of examples through the journey where we think the market hasn't really picked up and haven't read the documentation thoroughly to understand where their risk position is. And, I always refer back to the David Jones story of, I really didn't like David Jones' credit because it was a consumer cyclical and basically would move up and down with the economy. And when we did, the research and reading the documentation, we realised that David Jones had like a guarantee against the department stores in both Sydney and Melbourne, and a warehouse in Truganina. So we sort of went away from looking at this credit as a consumer, cyclical, to being a property lend. So they're the sort of things that you can sort of identify by reading documentation, or also, where's the weakness in a structure that isn't, might mean that you're not getting paid enough return for that risk. So every deal we look at, we read the documentation, and I would recommend to all investors listening to this, they should do the same.
ESG analysis is a key part of your risk management as well. How do you incorporate ESG factors into the credit assessments? And can you share an example of how ESG considerations have influenced an investment decision?
So ESG forms, a part of our internal credit rating process. It generally gets a weight of about 20-30% to the actual, depending on the business structure of our internal credit rating. And we use ESG as both a screening tool, but a relative value tool. So first of all, as a screening tool, it's, we have a minimum hurdle for every company to get into the fund. And we've had many companies that have not met that minimum hurdle. They will generally come from predator lending, like, payday lending, online gaming, where you might not have that sort of regulation around and protections in place on online gaming. Although financially those companies are great, right? So, or we can have a view on, we tend to try and avoid, pure play thermal coal, but we're very open-minded about metallurgical, which you need for making steel. So that screening process is probably the first stage. The second stage for us is relative value. And because we've incorporated the ESG into our credit rating, if a company has a really poor ESG process, and that can be a number of factors, could be E, S, or G, and if they do have a poor ESG, that will have a tendency to drag down the internal credit rating. So what that will mean for us is, if that's the case, then, and we're 1 notch below what the market is pricing that security as, it means we need to get rewarded more in return to justify that security getting into the portfolio. So it becomes a relative value. We've had plenty of examples where, through the Royal Commission and into the Financial Services Inquiry, we had situations where our internal assessment of ESG was too high for companies, what we were hearing through that Royal Commission. So we actually reassessed our ESG on those particular companies, and their internal rating was notched down, and we weren't getting paid for the risk. So we sold down those securities and exited and re-entered when those companies improved their ESG, or the credit spread required got out to a level that we were prepared to buy again. So it's a screening tool, but also a relative value tool.
And speaking of being paid for risk, fixed income investing is all about balancing risk and reward. What are the key risks that investors should expect to be compensated for in credit markets, and how do you ensure that the fund is positioned to capture attractive risk-adjusted returns?
Yeah, so I think probably the biggest mistake that investors make in my world in credit is that sometimes, particularly if you're getting into the non-investment, investment grade companies that are in that higher yield type space, there's a fine line between, is the security you're investing a equity security or is it a fixed income security? And sometimes we've seen through the journey that some securities are too equity-like, which we don't have a problem with. But if you're not getting paid for that equity-likeness, then you really shouldn't be there. And we've seen many of the securities we've avoided that have got into trouble over the journey have been those types of securities. I think the other thing that is really important from a credit point of view is illiquidity. We're very conscious in, you do the credit work, you do the documentation, but if a security, is going to be liquid, and that could be because of the number of securities on issue, the market willing to support buying and selling on that security, you need to be compensated for illiquidity premium. And there's times in markets where you get compensated for illiquidity, and there's times when you're not getting. So we tend to try to assess that illiquidity risk. And although we might like a security, if you're not getting compensated for all the risks, there's no point being there. So we try to bring all those things together, that internal rating, the documentation, the liquidity, where does this portfolio sit in our portfolio construction from fixed to floating? And in some ways that brings that risk-adjusted returns into play. And we sort of tick, yes, we're getting paid for that. Yes, we're getting paid for the credit. We're getting paid for the liquidity. We're really comfortable. So, and in some ways that gets you, yes, we want to buy this security. And then you've got to think about, well, if we're going to buy this, what do we replace it with? So we're all constantly assessing that, are we getting paid for risk? And that's how you turn your portfolio over and hopefully add alpha.
So this April, the Enhanced Income Fund delivered a positive return despite the volatility surrounding Liberation Day. What do you attribute this outperformance to, and how does your team navigate periods of heightened market uncertainty?
We're pretty proud of how April played out, not just because we had a positive return in April, but in some ways what we've been communicating to clients is that fixed income, when you have a running yield of 5.5% to 6% in a fund like this, has its defensiveness back. When interest rates were 0 3-4 years ago, fixed income lost its defensiveness. So we're pretty proud of the fact that what we've been saying actually played out in a real event like April. What I would say to people, I think it's really important. A fund like the Enhanced Income Fund has many levers to protect, and we went into that period really well positioned to take advantage of Liberation Day. We'd raised our cash levels. We'd actually increased our interest rate duration with a focus on the front end of the yield curve. We had a view that yield curves would steepen, and because we were positioned that way, and the market reacted the way we thought it would with a risk-off type scenario in April, we were able to deploy capital, the cash, buy things when they were cheap. The yield curve steepened from about 70 basis points to 120. We were able to take profits on that. We were along the front end of the yield curve in Australia because all of a sudden people were talking about more rate cuts. So we were able to take advantage of that. So we were really well positioned for it. But what I would say to investors is that, when they look at a fund, a fixed income fund, does someone have the flexibility to be able to react to the market environment? And that's really, really important. I think that's what April did for us, was to highlight that this fund's set up to take advantage. And I think that's the one thing, active investment versus passive investment. Passive tends, you're up against a benchmark and people just don't have that flexibility, whereas an active manager can actually assess the macro environment and position the portfolio to take advantage of that or protect capital as well.
So you've witnessed the Australian credit market evolve over your career. How has the market changed, and what makes it a compelling investment opportunity for clients today?
Yeah, I only said to someone in last week, I think it feels like to me the Australian credit market has finally grown up, and it's probably taken 25 years or 30 years for that to take place from when it probably started in the mid-90s. And it's the most liquid, deepest market I've seen, to the point where, from an issuance point of view, I think we're now the third biggest market in the world behind the US dollar and the euro market. So we've overtaken the pound and the Canadian dollar as a bigger market, and that's a big thing. It's come about because Australia looks really attractive from a macro environment. I often say to people it's a bit Goldilocks for credit at the moment, 2% growth, low inflation. But people outside looking into Australia are seeing a stable government of 6 years. The macro environment looks good. We're a long way from a lot of the geopolitical risks of the world, and we're probably a net beneficiary from a tariff viewpoint. We're not hit really hard. So we look like a great place. Our Aussie dollar looks a bit cheap. So we're starting to see a lot of Asian flows into Australia, and that's helping this country as credit market to develop even more, which is a great thing for a fund like ours, because the more issuers we see in the marketplace, the more ability for us to add alpha.
And finally, looking ahead, what's your outlook for the fixed income market over the next 12 months? Are there particular trends or risks that you're watching closely?
Yeah, so it's a really interesting question. I mentioned earlier that macro and the bottom up and top down. Today, it feels to me like we're almost back at February, March. It feels like credit spreads have got to a point almost identical where we were back in February, March. Equity markets feel a bit more extended from a valuation point of view. So bottom up, I feel really comfortable about that bottom up credit. Australian companies are in great shape to handle pretty much any environment. Macro-wise, Australia looks great. It really does look fine from my perspective. Then you look at the US, and that's what concerns me a bit. So I sort of think that, we could be in for an environment where you do see a bit of risk off. So I'm preparing myself for that again. I'm not sort of doomsday person. I think it could be really more about a revaluation, more so than a sort of a global financial crisis or a pandemic. It's more of just a revaluation of risk, probably similar to what we saw in April. So I've raised my cash levels. I put a bit more interest rate duration on the front end of the yield curve, because we've only got 2 rate cuts built into Australia, and Yarra thinks we could have 4 rate cuts by the end of 2026. So we have a terminal cash rate at 2.6. So we're trying to take advantage where we think there's value, and also position ourselves for if there is a risk-off event in the coming months, we can take advantage of it just like we did in April. So it's really weird environment. Australia looks great. We're getting great flows into Australia. Bottom up looks awesome. But I still have this fear of the US at the moment.
Roy, thank you for joining us today and sharing your insights into the Yarra Enhanced Income Fund and the Australian credit landscape. To our listeners, thank you for tuning in. We hope you found this discussion informative. Thanks, Roy.
Thanks, Holly.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.